All right, today we're putting a very specific financial strategy under the microscope, the child-run LLC. We're going to treat this just like a product review. We'll look at the features, the performance, and whether it's actually a tool you should consider. Let's dive in.
So you're a business owner, and the big promise here is pretty incredible, right? Can you actually take money you're probably already spending on your kids and turn it into a legitimate tax-deductible business expense? Well, we're here to break down exactly how it's supposed to work and see if it really holds up. This video contains affiliate links. Before we dive into the exact steps of shifting income and maximizing those massive tax deductions, let's talk about the foundation. You absolutely cannot build a wealth-generating, child-run business without a properly structured business entity. Most parents try to hire their kids or set up a side hustle for them under a basic sole proprietorship, mixing everything into their own personal taxes. And that's exactly why they trigger an IRS audit and get their deductions completely thrown out. If your child is going to own an income-producing asset or run a legitimate business, it needs to be a separate, legally compliant entity. That's where Busy comes in. Because minors cannot legally sign binding contracts or open business bank accounts on their own, setting this up correctly as a parent or guardian is critical. Busy handles the entire LLC formation process for just $0 plus state fees. They take care of the heavy legal lifting for you, filing the articles of organization with you as the authorized adult, providing your required registered agent service, securing the EIN, which you absolutely must have to run legal payroll for your child or open a custodial business account, and setting up your compliance alerts. Most importantly, they give you the framework to create a customized operating agreement that officially outlines your child's ownership stake while you manage the contracts until they turn 18. This is non-negotiable if you want to legally build generational wealth and lock in those tax savings safely. I've put a special link in the description below. Use my link to get your child's LLC set up right through Busy today and unlock some exclusive discounts and perks. Get that legal foundation handled first, and then let's get back to the tax strategy. So what are we really talking about here? At its heart, this is a formal way for you, the business owner, to pay your child for real work. But here's the twist. Instead of just adding them to your payroll, you pay a totally separate company, an LLC that your child owns. The whole point is to turn a family expense into a formal and, most importantly, a deductible business expense.
You know, the engine that makes this entire thing go is a concept called income shifting. It's not some weird loophole. It's a known tax planning idea. Think of it like this. You're just moving income from your bucket, which is in a high tax bracket, over to your child's bucket, which is often in a 0% tax bracket. Simple as that.
Okay, so let's get into the nitty-gritty, this setup. This is where we look at the actual mechanics of how you'd put this strategy into practice. And I gotta stress this right off the bat. If you're gonna do this, you have to do it perfectly, by the book. No cutting corners. The whole process, according to the financial advisors who push this, involves these 5 pretty distinct steps. You see, it's not as simple as just slipping your kid a 20. You have to form a real legal entity, keep the money separate, handle the payments formally, use that income for retirement, and, this one's huge, document absolutely everything. So step 1 is all about creating the actual legal company. That means picking a unique name, filing the official paperwork with your state, the whole 9 yards, and then getting a tax ID number, or EIN, from the IRS for this new business. And here's an interesting tidbit. Some states, like Delaware, California, Ohio, and Wyoming, actually have specific rules on the books that allow a minor to be the sole owner of an LLC. Now listen up, because this is where the IRS really puts you under the microscope. The work has to be real. It has to be legit. You can't just pay your 5-year-old a consulting fee for being 5. But what you can do is pay them for real age-appropriate stuff, like cleaning the office, modeling for your company's website, doing administrative tasks, or if they're older, maybe even managing your social media. And the pay has to be reasonable for that job. Okay, and this is a huge fork in the road we found in our research. How do you actually get the money to your kid's company? Some advisors will tell you, hey, just issue a 1099 to the LLC, treat it like any other contractor, it's simple. But others are practically screaming, no, use a W-2 and put the child on your business's payroll. Believe me, this is not a small detail. The tax difference is absolutely massive. Right, that 1099 path can blow up in your face. Just listen to this quote from Mark Kohler, who's both a CPA and an attorney. He says flat out, don't do it. Why? Because a 1099 makes your kid an independent contractor in the eyes of the IRS, and bam, that triggers a 15.3% self-employment tax on everything they earn. That tax bill alone can just vaporize the savings you were trying so hard to create. And this is where the strategy starts to look really powerful over the long haul. As soon as your child has legitimate, documented earned income, they can now open and contribute to a Roth IRA. That means the money they're making can be invested and grow completely 100% tax-free for decades. I mean, that's a massive wealth-building feature. All right, let's talk performance. Let's look at the numbers. Because let's be honest, the whole reason this strategy is so tempting is the potential tax savings. So how much are we really talking about? Let's break it down. Okay, this number right here, this is the magic number. This is what makes the whole thing tick. For 2025, the standard deduction is 15 grand. That means your child can earn up to that amount in a year and pay zero federal income tax. That is the bedrock of the tax-free money claim. So let's just walk through a quick example. Let's say you pay your child $10 an hour for 10 hours of work a week. That's about $5,200 a year. So what happens? Your business gets to deduct the full $5,200 as an expense, which lowers your business's taxable income. And for your child, since that $5,200 is way under the standard deduction, they owe exactly zero in federal income tax. And here's what you can do with that tax-free cash. For 2025, your kid can put up to $7,000 of their earnings into a Roth IRA. So going back to our example, they could take that entire $5,200 they earned and put it to work, compounding tax-free for the long term. Pretty amazing. All right, we've seen how it's supposed to work. We've seen the numbers on paper. Now it's time for the reality check. Every single strategy has its upsides and its downsides, so let's put them head to head. Okay, here's the final spec sheet. On the pro side, it's pretty compelling. Your business gets a full tax deduction. You shift income to a 0% tax bracket. You kickstart a Roth IRA for your kid. And hey, it's a great way to teach them about work and money. But the cons are serious. You must have legit work and perfect records. There is a high risk of an IRS audit if you mess up. The setup can get complicated, and that conflicting advice on the 1099 versus the W-2, that creates a real legal risk. So after digging through the features, the performance, and all the risks, it's time for our final verdict. Is this strategy a buy? Is it something we can actually recommend?
Here's our top-line summary. The child-run LLC is a powerful financial tool, no doubt, but it is incredibly high maintenance. Think of it like a high-performance race car. The potential is huge, but it needs constant attention and perfect execution. This is absolutely not a set-it-and-forget-it kind of deal.
So, what are the absolute must-knows? First, the work has to be real and the pay has to be reasonable, no exceptions. Second, paperwork. Timesheets, job descriptions, invoices is your only defense if the IRS comes knocking. And third, and this is truly non-negotiable, you have to talk to a qualified tax professional before you even think about trying this. The consequences of getting it wrong are just too severe. Which really leaves us with one last question, and this one is for you to answer. When you weigh the potential tax savings against all the administrative headaches and the very real risk of an IRS audit, is it worth it? Is that a trade-off that makes sense for your business and your family? Well, that's a call that depends entirely on how diligent you're willing to be and, frankly, your stomach for risk.